Preparing for accounting at Con Edison interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 primary financial statements and how they connect. The income statement measures performance, the balance sheet shows financial position, and the cash flow statement explains changes in cash. Net income flows into retained earnings, while balance sheet movements help reconcile operating, investing, and financing cash flows. For example, depreciation reduces earnings but is added back in operating cash flow. At Con Edison, I would also connect capital spending, asset additions, debt financing, and operating cash generation because utilities require significant ongoing infrastructure investment. While answering, focus on the income statement, balance sheet, and cash flow statement. Explain retained earnings, non-cash adjustments, working capital movements, and why consistency across statements matters during a utility accounting close. Question 2. Why is accounting for a regulated utility different from accounting for an ordinary company? A regulated utility operates under approved rates designed to recover prudent costs and provide an authorized return, so accounting must reflect the timing of that recovery. Under U.S. generally accepted accounting principles, qualifying regulatory assets defer costs expected to be collected from customers, while regulatory liabilities defer amounts that benefit customers later. That creates a different matching pattern from an unregulated company. I would evaluate both the underlying transaction and whether regulatory treatment is supportable and documented. Make sure to cover rate regulation, cost recovery, regulatory assets and liabilities, matching of revenues and expenses, commission oversight, and how approved rates influence financial reporting and management decisions. Question 3. What are regulatory assets and regulatory liabilities, and how would you account for them? A regulatory asset represents a cost incurred today that the regulator expects customers to fund through future rates. A regulatory liability generally represents amounts collected or benefits received before the related cost or customer benefit occurs. I would record the balance only when recovery or refund is probable, maintain supporting regulatory orders, and amortize it consistently with the approved recovery period. I would also reassess collectibility because changing regulation can create impairment risk. In your answer, talk about deferred recoverable costs, customer benefits, probable future recovery or refund, amortization through rates, documentation, and the importance of assessing whether regulatory treatment remains appropriate. Question 4. How would you account for property, plant, and equipment at Con Edison? I would capitalize expenditures that create or improve a long-lived asset and expense routine repairs or maintenance. During construction, costs would generally accumulate in construction in progress, including eligible labor and directly attributable overhead, then transfer to the appropriate asset class when placed in service. Depreciation would begin at that point using the approved method and useful life. I would also process retirements accurately, because utility asset records and rate base reporting depend on complete, auditable details. Be sure to mention capitalization criteria, component tracking, construction in progress, placed in service dates, depreciation methods, retirements, asset records, and the distinction between repairs and capital improvements. Question 5. What is AFUDC, and why is it relevant to utility accounting? AFUDC, or Allowance for Funds Used During Construction, represents financing costs associated with qualifying utility projects while assets are being built. Rather than expensing all eligible costs immediately, the company capitalizes the applicable allowance into the project cost, subject to accounting and regulatory requirements. Once the asset is placed in service, the capitalized balance is depreciated over its useful life. I would verify project eligibility, calculation inputs, and regulatory treatment before recording AFUDC. Focus on allowance for funds used during construction, eligible construction period financing costs, capitalization principles, rate base implications, and the need to distinguish AFUDC from ordinary operating interest expense. Question 6. How would you record revenue for an electric or gas utility? Utility revenue is generally based on customer usage under approved tariffs, but billing dates rarely align perfectly with month-end. I would record billed revenue and estimate unbilled revenue for consumption delivered before the reporting date, using reliable usage and rate data. The estimate would reverse or true up when actual bills are generated. I would reconcile meter information, billing reports, cash collections, and the general ledger, while separately considering taxes and pass-through charges. Make sure to cover customer usage, billing cycles, unbilled revenue, estimates, tariffs, collections, regulatory mechanisms, and reconciliations between meter data, billing systems, and the general ledger. Question 7. What month-end close process would you follow in a utility accounting role? I would begin with a close calendar assigning owners, deadlines, and review responsibilities. Key steps would include reconciling subledgers to the general ledger, recording payroll and vendor accruals, updating depreciation and capital activity, reviewing regulatory balances, and validating revenue estimates. I would perform variance analysis against budget and prior periods, investigate unusual movements, and document explanations. Before finalizing, I would confirm approvals, resolve open reconciling items, and communicate material issues to management. In your answer, talk about the close calendar, subledger reconciliations, accruals, estimates, regulatory balances, fixed assets, intercompany activity, analytical review, approvals, and post-close adjustments. Question 8. How do you distinguish a capital expenditure from a repair and maintenance expense? I would capitalize a cost when it creates a new asset or materially extends useful life, increases capacity, improves efficiency, or provides another measurable future benefit. Routine maintenance that preserves an asset's existing condition would normally be expensed. I would review the work order, scope, expected benefit, dollar threshold, and accounting policy rather than relying only on the invoice description. When judgment is significant, I would consult technical accounting and retain clear documentation for audit review. While answering, focus on future economic benefits, useful life extension, increased capacity, improved efficiency, materiality, company policy, supporting documentation, and consistent application across similar projects. Question 9. How would you investigate a significant variance in operating expenses? I would quantify the variance and compare it with budget, forecast, prior periods, and operational drivers. Then I would separate timing, volume, price, one-time, and classification effects. For example, a storm-related increase might reflect emergency labor, contractor costs, and materials rather than recurring overspending. I would trace the largest entries to invoices or journals, discuss operational context with the budget owner, correct errors if needed, and document a concise, supportable conclusion. Be sure to mention defining the variance, comparing periods and budgets, separating volume, price, timing, and classification effects, tracing transactions, consulting stakeholders, and documenting the final explanation. Question 10. What controls are important over the utility accounting close? Important controls include restricted journal entry access, independent approval of manual entries, timely account reconciliations, review of estimates, and segregation between preparation and approval. I would also pay close attention to interfaces between customer, purchasing, fixed asset, and general ledger systems, because data transfer failures can create widespread errors. Evidence should show who performed and reviewed each control, when it occurred, and how exceptions were resolved. Strong controls improve both reporting reliability and audit efficiency. Focus on segregation of duties, journal entry approvals, account reconciliations, access controls, review evidence, system interfaces, estimates, exception reporting, and timely remediation of control deficiencies. Question 11. How would you reconcile a general ledger account with its supporting detail? I would obtain the general ledger balance and the relevant subledger or external support as of the same date. I would agree opening balances, reconcile additions, reductions, transfers, and ending balances, then investigate differences by age and materiality. Each reconciling item should have an owner, explanation, and resolution date. I would post corrections only after validating the source, preserve supporting evidence, and obtain independent review. Recurring differences may indicate a process or interface problem requiring remediation. In your answer, talk about obtaining the trial balance and subledger, agreeing opening balances, reconciling transactions and ending balances, identifying reconciling items, aging exceptions, and securing reviewer sign-off. Question 12. What is depreciation, and how would you evaluate a utility asset's useful life? Depreciation systematically allocates a depreciable asset's cost over the period it provides service. I would consider the asset class, engineering expectations, operating conditions, maintenance strategy, replacement cycles, residual value, and any regulatory guidance when assessing useful life. Depreciation begins when the asset is ready for intended use, not necessarily when construction starts. If new evidence changes the estimate, I would treat that as a prospective change and document the analysis and approval. Make sure to cover systematic allocation, depreciable basis, service commencement, useful life, residual value, asset classes, componentization, regulatory approval, and revising estimates when facts change. Question 13. How would you account for an asset retirement obligation related to utility infrastructure? An asset retirement obligation arises when the company has a legal obligation to retire or remediate an asset, such as removing certain infrastructure. I would recognize the liability at fair value when it is probable and reasonably estimable, using a present value approach, and record a corresponding increase to the asset's carrying amount. The liability accretes over time while the asset-related amount is depreciated. I would update assumptions for timing, costs, and regulation when circumstances change. Be sure to mention a legal obligation, present value measurement, probability assessment, initial liability, corresponding asset, accretion, depreciation, updated estimates, and regulatory recovery considerations. Question 14. What accounting issues can arise from storm costs or other unusual operating events? Storm events can generate substantial emergency labor, contractor, materials, restoration, and customer support costs. I would determine which expenditures repair existing assets, which create qualifying improvements, and whether insurance or regulatory recovery applies. I would accrue incurred but unbilled costs, track costs by event, and avoid netting recoveries against expenses unless the accounting guidance supports it. I would also assess materiality, disclosure needs, and whether deferred regulatory treatment is probable and properly authorized. While answering, focus on emergency expenditures, capitalization versus expense, insurance recoveries, regulatory recovery, accrual completeness, materiality, disclosure, and separating one-time impacts from recurring operating costs. Question 15. How would you assess whether a regulatory asset remains recoverable? I would review the commission order, approved recovery mechanism, remaining amortization period, and recent rate case developments. Then I would assess whether future customer collections remain probable using updated forecasts, regulatory decisions, and relevant legislation. If recovery becomes uncertain, I would quantify the exposure, consult technical accounting, and evaluate impairment or write-off requirements. I would document the conclusion and assumptions clearly, because regulatory balances can materially affect earnings, equity, and reported cash flow expectations. In your answer, talk about current commission orders, rate case outcomes, customer recovery mechanisms, probability, amortization, changing legislation, forecasted cash flows, impairment indicators, and escalation of uncertainty. Question 16. How do accounts payable accruals affect the financial statements and close quality? An accrual recognizes an obligation when goods or services have been received, even if the invoice has not arrived. It increases the appropriate expense or asset and the related liability, preserving cutoff and completeness. I would use purchase orders, receiving reports, service confirmations, historical patterns, and subsequent invoices to estimate the balance. At the next close, I would reverse or true up the accrual, investigate unusual aging, and prevent duplicate recognition when the invoice posts. Focus on incurred obligations, cutoff, completeness, goods received, services performed, subsequent invoices, reversals, expense and liability recognition, and avoiding both understatement and duplicate accruals. Question 17. Tell me about a time you found and corrected an accounting error. In one close, I noticed a depreciation variance that did not match the month's asset additions. I traced the issue to an asset placed in service with an incorrect date, quantified the earnings and balance sheet impact, and prepared a correcting entry after review. I then checked similar records to determine whether the problem was isolated. Finally, I added a placed in service validation to the close checklist and documented the root cause, correction, and preventive control. Be sure to mention the situation, detection method, quantified impact, root cause analysis, correction, communication, control improvement, and how you verified the issue would not recur. Question 18. How would you explain a complex accounting issue to a non-accounting manager? I would begin with the business question and financial impact rather than accounting terminology. For example, I might explain that a regulatory asset means costs are recorded now but recovered from customers over future periods, subject to approval and probability. I would quantify the effect on earnings, cash flow, and rate decisions, distinguish confirmed facts from assumptions, and present the recommended action. I would then invite questions and confirm responsibilities, deadlines, and documentation requirements. In your answer, talk about starting with the business impact, using plain language, separating facts from judgment, quantifying financial consequences, presenting options, and confirming the manager understands required actions. Question 19. Why do you want to work in accounting at Con Edison? I am interested in Con Edison because its accounting supports essential infrastructure and a business with meaningful regulatory, operational, and capital investment complexity. The role would let me apply strong fundamentals while learning utility-specific areas such as fixed assets, regulatory accounting, and large-scale close processes. I also value the company's public responsibility. Accurate reporting affects investors, regulators, customers, and funding decisions. My strengths in reconciliation, analysis, control discipline, and communication would help me contribute immediately. Make sure to cover interest in infrastructure and essential services, regulated industry complexity, reliable reporting, professional development, teamwork, public accountability, and how your skills match the role's responsibilities. Question 20. If a utility project is delayed, what accounting and reporting issues would you evaluate? I would first confirm whether costs remain properly classified in construction in progress and whether any expenditures should be expensed because the project scope changed. I would reassess the expected placed in service date, depreciation start date, AFUDC eligibility, budget variance, and potential impairment indicators. I would also evaluate regulatory recovery, contractual commitments, and disclosure requirements. Finally, I would reconcile project records to the ledger, obtain updated engineering assumptions, and communicate the financial impact clearly to management. While answering, focus on construction in progress, capitalization of eligible costs, placed in service timing, AFUDC, impairment indicators, budget variances, regulatory recovery, commitments, disclosures, and communication with project owners. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.